I still don't get the music thing. I've got no music here.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, CSW, nor its affiliates, nor any of the respective offices. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, and registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the SEC website, www.optionsclearing.com, to read characteristics and risks of standardized options. CSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified day. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
Okay, fantastic. Let's see where we are now. All right. The music of Phil's voice. No one ever accused me of that. So I come from a very musical family too, and I'm so not talented in that regard. I cannot play an instrument and I cannot sing. My mom's side is all singers, and my brother's an excellent singer. He was professional. On my mother's other side, they're all musicians, like really famous musicians. People who play the symphonies and stuff. And me, no, none of those talents. I'm forbidden to sing at family functions. I throw the whole family off. Anyway, so let's see how the market looks. Unbelievable. Look at this. I mean, this is freaking You start off down here, and we're up 100 points from the open, basically, on the Dow. It just goes, doesn't matter what's going on. Just if the market's open, the Dow's going to go up. And why is that ringing? All right. That's an alert. Hang on, let's find out what this is about. Hello?
Good afternoon, everyone. This is Richard Hennessy from Mortgage Market Data. It's 1:04 p.m. here on the East Coast. Mortgage securities have been moving lower after the strong existing home sales report, and as the Dow turned positive and ahead of the auction results. So I advise clients to lock here. If there are any changes, we'll get back to you. Have a great afternoon.
Let's see, TLT. Oh, wow, that is a pretty strong move. So basically what they're saying is TLT took a dive. I don't know if you could hear that, but they're basically saying that the rates took a dive after the strong housing notes. Didn't take a dive. They went up. Sorry. The strong demand for housing caused the rates to go up, which causes TLT to go down. So that's pretty significant. And we'll see where it straightens out. But it's a weekly fluctuation. It's not really a big deal. But it is something, I mean, obviously over the course of the year, you always want to keep your eye on rates. Rates is one of those slow-moving things in the market that it matters, but it matters a lot, but it doesn't change enough to worry you day to day. It's very, very rare something super significant happens in rates. And of course, at 2 o'clock, we have the Fed coming on to, the Fed, it's only the minutes of the Fed's last meeting. The gist of the meeting has been, or the statements that the Fed has made since the meeting have been generally towards like saying they're going to do 3 cuts this year. So here's the thing, and here's why I think March is on the table. Because if we go over to FOMC meeting, yes, calendar, there you go. Okay, so if we look at the year, here's their statement, which we know is bland. They're going to give the minutes, will be out shortly. And we're going to get the minutes of this meeting. And in March, so they have, if they're going to raise rates 3 times this year, and everything I hear says they're going to raise rates 3 times. Also, the economic conditions and the market conditions are so overheated, it would be so irresponsible not to raise rates. I mean, waiting until May is another a month and a half to wait until May. That's a pretty long time to not take an action when you're into inflation and pressures are seriously mounting up. So I would be kind of surprised if they don't raise rates at the March meeting, on the path that we're on now especially. If not March, then they have to raise every other meeting to do 3. They're probably not going to do 2 in a row. So you've got to figure they do May, July, and October. They can pull that off. That wouldn't be horribly disruptive to the market. Nobody even notices what they do in July. May, by the time it is May, if the market is still on good now, see their logic, and I think this is how they could skip the March meeting, their logic is going to be, okay, well, look, we want to raise rates 3 times this year. We could start in March, but then if we start in March, what are we going to do, coast into the end of the year? So if we start in March, if we skip March and wait till May, the only thing that's going to happen is that the market is going to continue to be hot, and that employment will continue to be hot, and inflation will continue to be hot. And then in May, everybody will say, well, of course the Fed's going to raise rates. They have to. So that's the logic for them waiting. All right, so it kind of makes their life a little easier. Now, on the other hand, though, it cuts back on the flexibility in case hiking rates doesn't help. So everybody's thinking about the one way that hiking rates is going to slow down the rally and slow down inflation and so on and so forth. What if hiking rates does nothing? What if the market takes a 0.25% rate hike and says, look, and it keeps going up, and we're back into that 1999 bubbly kind of thing. And at the same time, if that's happening and inflation is kicking up, then what's going to happen to them is, and this is the worst thing for the Fed, by the way, if real rates start going up faster than the Fed keeps pace with them, then the Fed is way behind the curve, and that's a problem for them. And it causes all sorts of disruptions in the banking sector, and it imbalances the system. So they don't want to be that far behind the curve. So if there's this huge demand for money, and rates start going up naturally, and the Fed isn't raising their rate, then money goes away from the Fed. In other words, they're not offering a high enough rate, and the government's not offering a high enough rate to attract capital. Capital starts flying into other lending sources and other bonds and so on and so forth. And then all of a sudden they've got bad auctions, and then the auction rates spike. People get worried about giving the government $100 billion a month to survive. That kind of crap. Actually, it's not even $100 billion anymore. I think our deficit's chopped down to like $500 billion or $600 billion, which is still gigantic. It's still, the GDP of all but like the top 20 nations. So, like we're losing, we're losing Italy every year, basically, something like that. Every year we go another Italy into debt, and everybody's like, "Oh, Italy's GDP is a crisis." It's like, no, we're a crisis. We're going to debt their entire GDP on an annual basis. They're only going into debt 10% of their GDP every year. Anywho, so Fed, we'll see what the Fed says, but my impression is that March is I think 60%. I mean, if I were on the Fed, although waiting till May is a great kick the can down the road move, it does mean they have no choice in May but to raise rates. And they don't like having no choice. Going in March means that they're completely flexible all year. They can go, skip, go, skip, go, skip all year long, just because they do this one hike here. So, you have to imagine the Fed governors have a thicker skin than that they're not going to be so sensitive to how people get upset that they raise the rates in March and it might have been too early. I think they'll be like, okay, you know what? We're pretty sure it's the right time to raise rates. Let's raise rates, see how that works out in May. And then we'll probably not raise rates again until June, but at least we're on track. I think that would make them happier. And that way, if the economy does dip, they can always reverse or not raise rates, and either one's going to have a good effect. But by not raising rates now and the economy keeps moving along and overheating, that's not going to look good. And by the way, just as bad, if they don't raise rates and the economy starts to tank, they got no wiggle room to go lower or to ease. And also, they're going to lose credibility if they don't raise rates at some point. So lots of reasons to raise rates in March. So I'm in the 60-65% camp on that one. Almost 2/3 chance that they're going to do it. Brian loves audio. Okay. Let's see what else. All right, back to the thing. Back to the futures. All right, so the Russell, sort of reliable to short in this range in 1405 to 1410. The S&P clearly harshly rejected here, 2365. If we look at the Dow, YM, wow, 207.50. That's a really tempting shorting line. That's wild. It's a 5-0 line. It's an attractive short. Should we have a go at that one? What do you think, guys? I don't know. Let's check the news first. If you're not sure, read. That's my theory. Okay, we'll go to Seeking Alpha. Market news. And all news. Amazon matches Walmart's no fee shipping minimum. Well, that's interesting. Then why am I a Prime member? So now I'm only a Prime member because if I order just only like one thing, which my kids do all the time, they order like one thing for $5 and Amazon ships it. It's so stupid. Like they'll order a pencil or something or a pen and Amazon ships it for free. It's incredibly wasteful. And okay, Walmart, yeah, 20. Okay, I was talking about that yesterday. It's like, look, Amazon's e-commerce numbers went up 10%. Walmart's went up 29%. Therefore, I don't care that Walmart obviously has a much lower number than Amazon. The bottom line is they're gaining ground. They are successfully gaining ground. 29%. When you're getting 29%, it doesn't take long to catch up to someone, no matter how big they are. It's very bad for Amazon if Walmart starts seriously competing with them online. I've been saying that for a long, long time. But doesn't seem to stop the investors. Nobody seems to care. I love Amazon as a short, but it's a deadly short, man. 850. Unbelievable. Or actually even more than 850. 855. So it's just a horrifying thing to short, but this was pretty good. I mean, they went down like $140 from here. This was not a bad short back in the fall. And, up here, this is just some silly money, man. I just think that, well, I like it as a short, but it's such a dangerous short. It's not one I would recommend, unfortunately. But I do like them as a short. I really think these are stupid valuations, and they're going to fall apart. But today, of course, we're doing Tesla. Also stupid. More so because I mean, I'm more sure about them being a bad idea because they acquired Solar City, who was losing a fortune as a separate company. And they're not going to stop them from losing money. They're bleeding cash. And Tesla is down to what, like $3 billion? Let's see what they got. Down to $3 billion. White man's problems, right? Financial revenue balance sheet. There we go. Ooh, no. Wait, quarterly. Aha! That's what I thought. Because they raised the money. Let's look at the cash flow. I'll show you what they did. So, see what they did? They sold like $2 billion worth of their own stock. Remember Morgan Stanley talked them up, and then they had a sale of stock. That's where they sold their own stock. They borrowed. It's $1 billion. You know, it's funny. This is quarterly, right? Yeah, quarterly. So in 4 quarters, they borrowed $1 billion, and they sold $2 billion worth of stock. So they basically borrowed. They borrowed and sold stock. They borrowed and diluted for $3 billion, which at the time was 10% of their company. Down here. Now it's not. Now they're at 40. You know, now they've gone from 180 to 280, and now they're like a $45 billion company. They were a $30 billion company before this happened. This is 30 billion, 180, 280, $45 billion. 50% increase. This is a 50% increase. That right there is funny. This is a $15 billion run in Tesla. And this is December. This isn't a long time. This is December. This is February. They didn't sell more cars. They didn't come out with anything new. They bought a company, Solar City, that's losing a freaking fortune. They've got no progress on the Model 3. It is scary, okay? The only thing I say they got going for them is they're building that gigafactory, but like there's this idiot talking about how valuable Tesla's going to be and so on and so forth. But look, we already have companies. It's not like they're the only company in the world that's selling batteries. I don't understand the premium that this company gets for everything that they do. Okay? They raised $2 billion to build a battery factory. Okay? But Tesla is a car company that buys batteries. So if they're selling the batteries to themselves and making a profit in the battery factory, then the car company is paying the profit to the battery factory. You know, I mean, hopefully they can, you know, they claim. Everything with Musk is a claim. Nothing actually happened. But they claim that these batteries are going to be significantly cheaper, so therefore it's possible that Tesla, the car company, can save money while Tesla, the battery company, makes money. Can happen. Seems unlikely. That's number one. Number two is they're not the only battery company. Panasonic has been doing it for years. Other people doing it for years. Samsung. Obviously, Samsung buys exploding batteries from somebody. But Tesla is hinging their sales to justify building this entire battery factory. You have to have customers. Right? Previously, Tesla's been buying their entire battery run from Panasonic. Now, they're going to start buying it themselves. Now they have no alternate source, so they have to keep the factory running, whether it's profitable or not. Otherwise, they're going to, because what are they going to do? Tesla is the biggest customer of the battery company. It's the only customer of the battery company because until they sign up more customers, I'm not a big believer in this thing. But right now, they're starting up with the only customer of the battery company. Now, this is fine in business. You know, if you're Hershey and you make chocolate bars and you're buying wrappers, and you're buying so many wrappers that you have like 5 factories working day and night making you wrappers, right? So building a factory for yourself to take up 20% of the load, where you feel you'll make some good money and save money and have more control on a wrapper factory, that makes sense, right? That's a logical business decision. And you can do it without it being too disruptive. But in Tesla's case, they don't buy enough batteries to justify building a whole factory. So Tesla has to say, okay, we know we're going to lose money on this factory, but there's 2 things we're hoping for. We're hoping we're going to sell 4 times more cars. 4 times more cars. We're hoping that other people will buy our batteries over Panasonic and other people. And we're also hoping to sell these battery doohickeys, the Powerwalls, for people's homes. And the Powerwall is an item. In fact, there was just an article about that I put up. When did I do that? Damn it. Full stock world. Ember's login. I'm already logged in. Is it today? This is not today. All right, choose this one. Was it today that I put up that thing about Australia or yesterday? I think it was yesterday. Control F. Oh, it was early this morning. It could be yesterday's post. Sorry. I want to show you the numbers here so you can understand it. There's a lot of this going. When you have a market that's just pumped up, a lot of this stuff goes on everywhere. But Tesla's like a real prime example of BATTER. I will find big batteries coming of age. Oh, that's it. That's not the right article. All right, but they're talking about like Mitsubishi, and there's a lot of people in this game. There's Mitsubishi, there's people we never heard of. They don't even mention Tesla. It's interesting. A123, Extreme Power, Beacon Power. They're talking about failures. He's at one-time high flies and ended up bankrupt. Okay, that's a good warning. Battery builders. LG Chemical, Boyd, and Samsung, big battery builders. Panasonic's in other. Tesla's not even big enough to be mentioned here. Oh, there they are. Tesla, LG Chem, Samsung, Panasonic, giving lenders confidence, big scale, bona fide, blah, blah, blah. But that's not the article I was talking about, and I don't know where it is, so I'm sorry. Nope, that's not it. Oh, well. Anyway, there was an article about Tesla installing the Powerwalls. Oh. Nope. Damn it. Aha! All right. So, this is a nice article. It's from Australia. And the gist of it is, this is what Tesla Powerwall thing looks like. Oh, that's the best picture they got? Oh, well. Anyway, that's what a Tesla Powerwall is. It's a big, giant battery that sits on the wall of your house. They keep it outside because if it bursts into flames, they don't want to kill too many people. So here's the thing. The math was what I was interested in. So the deal is, this thing, in addition to just being a battery that you can use in your home in case the power goes out, what it does is it redistributes your energy. So they're in places, and now again, in places where you're allowed to sell energy to your power company. And this is going to get completely wiped out. In America, there is no chance this is going to stand up. The power company is going to shut this down, and Trump's administration is going to help them shut it down. But in some places, what you can do is you can buy electricity when it's cheap, because electricity is different prices during the day. So when everyone's at work during the day, electricity is very cheap. So like right now, it's lunchtime here where I am. Electricity is probably the lowest price of the day. Also, I guess also like late at night, electricity is cheap. There's a surge time, like in the morning when everybody's waking up and everyone's using electricity, and in the evening when people come home and everyone's using electricity and cooking and all that crap. Those are the peak times for electricity. Energy is expensive then. Now, if you have a Powerwall doohickey, what you get to do is you get to buy electricity while it's cheap, fill up your battery, and then when electricity is expensive, you sell it back to the power company for a profit. That then offsets the cost of your electricity, right? So all sounds great. Here's the thing. Even in Australia, where this guy has an incredibly beneficial thing, and this is what, it's interesting because I see, you see these, if you read the stuff, I see a lot of these kind of articles in electric, and they're obviously planted by Tesla, and this is a best case scenario kind of example, is a shiny, happy family and people who are, using the Tesla Powerwalls, and they're so happy, and he's got his natural solar vest, so he's a solar fan. Okay, so he's like, this guy's totally into solar energy. Here's the thing. The Powerwall, they combined the product with a solar array and the Powerwall battery and a solar edge inverter, and it's $16,000. Okay? And his utility bill was $2,200 a year, and now he's only paying he's paying nothing basically. It's 92% savings. He paid $200. So that's fantastic. He's saving $2,000 a year. It's going to take him 8 years to pay back the cost. That's a long time. People don't actually own homes for 8 years on the average. So thing number one is, what the hell? It's all together. It's the solar on the roof and all this other stuff. Now, the way Solar City does this stuff to you is it becomes a lien on your house. Like they provide the system for free, and they're going to charge you less for your electricity, not 90% less, but they'll do the same kind of thing and charge you less for the electricity. The problem is, though, that Solar City, in order to make their numbers work, is they're doing the math as if this law is never going to change, and they'll always be able to sell at this price, and the utility company will never smarten up and say, you know what, we're going to charge a flat rate all day long. It's all the electricity company has to do. All they have to do is charge a flat rate all day long, and all this stuff is wiped out, because the whole thing is based on you're taking advantage of the electric company system. What they're trying to do, the electric company is trying to encourage people to buy when they've got overcapacity. So in other words, you should plan. If you have energy efficient appliances, a lot of them have timers and stuff, and if you should plan to set your machines to run, like your washing machine, your dishwasher, things like that, you should plan to turn them on when the electricity is when it's cheap. And also, it goes for people with electric cars too. They would like you to store up and buy electricity when it's cheap, but they don't want you to sell it back to them when it's expensive. That ruins their whole thing. Okay, so all you're doing is taking advantage of a loophole in the pricing structure of electricity. That's not something that's probably going to last for 8 years. And if that doesn't last for 8 years, then this poor guy is going to have his $16,000 system, and he'll still be paying $2,000 a year for electricity. So the thing is, you're taking advantage of loopholes. The loopholes will be drawn shut, and you won't be able to take advantage of them anymore. But even as it stands now, Solar City, their base premise here is what they do is they're financing the installation of these products. They're putting out, so they still own all these products. They have to depreciate all the stuff, and they're hoping over time they'll get paid back. All right, and a big problem, by the way, with Solar City though is you have to use them for 20 years. That's how they set it up. There's a 10-year, 8 years until it's paid back. They got to make some money, so they want 8 more years where they get, where they're selling electricity. But that means that when you sell your house, if you sell your house within 20 years, you can't get out of that contract. So the new person coming in to buy the house has to buy into a contract that they never really agreed to, and that also possibly they're not even going to really benefit from. All they're going to do is pay Solar City some electric fee. So all this stuff is based on a lot of assumptions that are not necessarily true. And in the early stages, it's easy to say, oh, this is all going to work perfectly, and you extrapolate it out, and so on and so forth. But the reality is this is a very tricky thing, and it sounds good, but it's not, it's certainly not dropping money to the bottom line hand over fist. It's not really saving Americans this kind of money. Okay, he's saving. It's very misleading, of course. He's saving 92% on his electric bill after he lays out. He's not getting the financing from Solar City. He's laying out $17,000 and he's saving $2,000. Okay, so he's saving 92% on the bill, but he's not really going to show any savings for 8 more years. Then he'll be saving. Now, there's perfectly good reasons to do that, though. If the system's going to last 20 years, you're going to save yourself 50% of your utility costs. Not to mention the fact that utility costs may go higher, you will continue to have the same very cheap electricity. That's great, but you've got to count on nothing changing otherwise in that 20 years, including you don't move. So as you can see, you're like closing a lot of these sort of markets are closing off and anything. Okay, of the people who don't mind laying out the money, and they're going to be here for 20 years, and they're not going to move, you keep eliminating these giant chunks of the population, and it gives you a limited target audience. And again, I love this thing. I wish this technology was mandatory. I think that's what they should do. They should be mandatory. But again, then you're like big government, so it's not going to happen. But everybody should have to have this thing. I think all homes should have to have solar roofs. Why would you not? Okay, any home that has a roof first of all, when you're building homes, it should be mandated that you build the home so that they face in a way that they have the optimal sunlight, and then you put a solar roof on the home. We have an electrical grid that needs $2 trillion worth of repair and upgrades. We're never going to do it. It's not going to happen. So what we have is a electrical grid that's strained, and we need to take strain off it, otherwise it will break. And break means gigantic blackouts that sweep across regions, because these transformers, they only last a certain amount of years, and a lot of them are long past their prime. They were installed in the 50s and 60s with presumably 30-year lifespan, and they're daring to double their lifespans. And when these things break, these are gigantic, almost small house-sized transformers, and they break, and they've got to be, another one has to be brought from somewhere and installed. It's not a fast process. So as they break, and especially if one breaks, see what happens, how the grid works. If one breaks, then all the ones around it have to make up for the electricity, but then the strain goes on them, and then one of them breaks. And if you lose 2 in a section, that's how you have these massive grid failures, because then the whole grid starts falling apart. There's going to be a lot of this stuff in the future. I mean, we're just never going to close the gap on infrastructure fast enough to prevent catastrophes, because nobody wants to face up to the fact how old our electrical grid system is. So there's a lot of stuff on that. Anyway, so bottom line is so you have this Solar City is Tesla picked up Tesla's fighting an uphill battle trying to get to profitability, and they picked up this lead weight of Solar City to carry them up the hill too. I can't see how this quarter can possibly be good or optimistic. But Musk is an amazing showman, so he'll possibly talk his way out of it. We'll see what happens. All right, so Matt says, any thoughts on NEP? It's a dividend stock. I don't have any thoughts on NEP. How much of a dividend? You got to be careful, because you have to understand what kind of a. Let's see if it says anything about them, like what they did. They acquire crude tankers, refined petroleum tankers, chemical tankers. They charter the vessels long term. I mean, I don't know anything about their business as far as that goes, so I couldn't tell you. I mean, it's nice that they pay a dividend. Wow, that's a huge dividend. I think it's interesting. I think it's worth looking into. So if you remind me in chat, I'd be happy to do a little bit of research because it is a lot of money. But I'm worried about a tanker stock when, this OPEC thing, it's a flighty situation. So how are they? Are they steady? Are they consistent? NEP. The money looks good. They are pretty consistent. That's not bad. For a high dividend stock, that's not so bad. All right, so what do we look at? Okay, so they're a small cap, so who knows, right? But they've got earnings growth. They have revenue growth. They have significant earnings growth, but we don't know if that's an aberration or not. See, that's what I need to find out. Why did they suddenly earn $27 million? That looks great. But why all of a sudden, when they were losing $28 million, made $1 billion, and maybe that's just because that's how that's turning them around, and maybe that's going forward going to be what it is. But this is basically a penny stock. So interesting, but I have no clue otherwise. Wow. Okay. Tesla also acquired SolarCity. Oh yeah, yeah, but that's the water under the bridge now. Okay, they acquired them. It's done. Yeah, I agree with that though. So their debt. On the other hand, yes, it's true. Their debt is very understated because it probably doesn't include what they spend on SolarCity or how they borrowed it. Can you imagine? So they buy SolarCity for what? Say $18 billion on the same price like that. And SolarCity's losing $1 billion or so a year. And so how do they service that debt? That's a good question. I should have asked that. You know what? You're right. That should have been the main question, Naomi. You are correct. That's ridiculous. How are they servicing that debt? Where's that money coming from? That's what I want to know tonight. If I'm on the call with Musk, that's the one I want to have answered. How is this debt being serviced? Who's paying? How are they coming up with this money? All right. Nobody's talking about the massive conflict. Well, that's done. But it's over. They already had it. They voted on it. The board of directors, which is Elon Musk and three of his friends, decided it was okay. They waived the conflict of interest. It really wasn't Elon Musk's cousin's thing. It was really Elon Musk's other company that his cousin was basically running for him. So that I think that was always the intent. I think Musk was basically thinking in his mind, like, whichever company does well first, we'll buy the other one and we'll consolidate them. I'm pretty sure that was like his goal from day one. But by having two separate companies and getting two separate fundings, it's a better way to get there. What's going on with SLW? I did get filled on 19-15 spread, but losing money on it today. Look, a spread is a weird little thing. And you can't watch a 2019 spread every day to see if you're going to make or lose money. Silver went down today, so silver wheat went down today, I'm sure. Okay? All you can do with a spread, because the money is going to fluctuate wildly. You have the $15 calls. Those have intrinsic value and virtually no premium. In fact, here, let's take a look. Not analyze. Okay, SLW. Okay, so you have, I never fixed this. I want to put delta on here. I don't know how. Wait. No. Option code. Delta. Yeah, but I don't want to change that one. Damn it. All right, wait. Oh, net change. Who needs net change? That's a stupid thing. Let's change that to delta. There. Okay. I just realized, I'm like, who cares what the net change is? All right. So, I want to just make sure you said 2019. I'm pretty sure you did. 2019. Okay. All right. So the 2019 $15 calls have a 77 delta. They're in the money. They don't have a lot of premium. The 20 calls have a 63 delta. Okay, so that is 14 cents less. So what that means is SLW goes down $1, your spread will lose 15 cents because the short calls that you sold will lose 15 cents less than the long calls that you own. So any time that is moving down, you're going to show a loss. And then it's 15 cents times 100 is $150 times however many contracts you have. Oh, I'm sorry, $15 times however many contracts you have. So it's not going to be pretty to sit there and stare at it all the time. It'll go up, it'll go down. But all you really care about long term is, are you on track to be over $20 in 2019? And as long as you're on track for that, nothing else really matters. Because in 2019, if you're at 20 or 30 or 50 or 100 or 10 billion, doesn't matter. Your spread, your 15s will be worth $5 more than those 20s. At any amount to infinity, your spread will be worth $5 as long as it's over 20. And then you'll get your full $5 back. In between, the prices can fluctuate all over the place like crazy every time this thing gyrates up and down. But none of it matters. It's either on track or off track. That's how you have to think of these things. You can't get thrown off by staring at your balances all the time. Frankly, these are like set and forget kind of trades. You really just buy them and you don't even look at them unless, you need to know your target, and unless your stock goes drastically off track, like here, if you were looking for 20 and you're okay, and then down here, get down to like below $15, and you say, gosh, I should probably do something about this. Now, what you should do is probably, buy more or roll the trade, because then you would reap the reward down here. Silver fluctuates up and down like crazy. We got a 2-year target, okay? Here, Stock Charts has a 2-year target. They say it's going to hit 34.50. That's their target. We don't care what it is as long as it's over 20. All right, but the net of these spreads, especially when you're the person taking the risk and buying the in-the-money part of the spread, you're the one that's going to suffer when it goes down, more so. And even when it goes up, though, sometimes sometimes the short call will gain a lot of premium because the expectations go up, but you're already in the money, so you don't really have a lot of premium to get if there's expectations going up. All right, so stop staring at it. That's the bottom line. Let's talk NGJ7. Okay, we can look at that. That is the natural gas contract. NGJ? Why J? Isn't NGJ is the current contract? Oh, yeah. Isn't it up to, yeah, April is current, yeah. Okay, so why are we talking about NGJ7? All right, here's what I'll say about NGJ7. I'm not playing it. I have no interest in it. See this? These are mine. NGV7. And, I have 2 because I stopped out at 2 when it went over 3 and went back down. I was in it like 295. So it probably, well, now I'm sure, the profit's messed up now because it thinks my average is 299 because I got out of 2 over here. Actually, no, that's not right. That is my average. I apologize. So I am down $800. But fortunately, got back to 3. I got out of 2, and now I have 2 long because that was my goal, was to improve my thing. Now that we're back down at 295, I'm going to be very happy to add. I'm going to let it settle down first and see what happens. So I'm going to be very happy to add a couple more longs. Everybody's getting rejected here. Did I do that short? No, I didn't do that short. Look at the bigger chart. Hang on a minute. So anyway, so that was V though. I'm playing the V contract because it's October. The current contract, April. Oh, that says March. Sorry. J. So the April contract is down. They haven't rolled the other one yet. The April contract is at the 270 line. All right, and we could go up or down from here. I mean, frankly, I'm expecting us to go lower because it's still not the right season. It's extra warm, and it's not the right season for natural gas to go up. So there's no particular catalyst to the upside. So I don't want to play this to the upside. What I'm doing is I'm trying to accumulate a position in the October contracts, and now it's the time to do it. Even if we go quite a bit lower, I'm happy to accumulate more. Because in the big picture, I'm not looking for a 5-cent run or a 10-cent run. I'm looking for a $1 run at $100 per penny, $10,000 per contract. Okay, that's my goal. So I'm accumulating the longer contracts for October and just going to wait patiently for the rest of the year. Here, first of all, the contract hasn't had a chance to establish itself yet. This is a mistake. A lot of people make this mistake. The natural gas contract. Okay, so this is the J contract that you're seeing here. It's already rolled over in this one. So the natural gas contract hasn't been trading as a front month contract long enough for you to know what the range is going to be. You have one move down here. You have no idea why. And you don't know if it's going to hold because this is a brand new contract. It hasn't had a chance to establish a floor or anything yet. Okay? I think $3 is probably the right floor. But that doesn't mean we can't go to 250 first. And I would love to go to 250. Okay, when have we been to 250? We haven't been to 250. I mean, we haven't gone any lower than we are now in all this time. Going back years. So I'm thrilled to be buying natural gas down here. I mean, yes, it's warm. Okay. It is warm today. It will be warm for 2 weeks or whatever, okay? But the year is 52 weeks. So let's say that we only use half as much gas for 2 weeks as we thought we were going to use. All right? That's going to be a 152 difference, because gas is 2 weeks. It's going to be a 152nd difference in total consumption, which is going to be 2%. So 2% less natural gas. And again, we're assuming that there's no other weeks where there's more demand. We're assuming that you're losing 50% of your demand in these 2 weeks, and you're not going to get that on Thursday. This thing will pop back up because everybody will say, "Oh, is that all?" You know, the change won't be enough to make it to justify this drop. I mean, we're down from $4. We're down from $4 on basically January 1st to $2.70. That's what, like, that 40%? Yeah, that's 40 frickin' percent. That's a pretty severe drop, okay? And we're not dropping 40% off some highs back to a more normal price. I consider this to be a more normal price, $4.50. We're not dropping back to a normal price. We weren't even at $4.50 and we're dropping 40%. We're like giving natural gas away. So I think for sure over the long term, I expect to come back to a more normal zone, somewhere in the $4 range. But will it be today, tomorrow, next week, a month, 2 months? I have no freaking idea. And there's no particular catalyst, certainly not the weather. There's no catalyst right now that's going to change that. So I wouldn't play it right now. I have no desire to play the front month, but I do have a desire, I have a strong desire at this level to accumulate October contracts. All right, and those October contracts are a premium. They're these. V7. So yeah, these October contracts are $2.95. Okay, but I started buying them when they hit 3. As soon as they hit 3, that was my buy point. I've been saying that for months. I've been saying if I can get those long-term contracts for $3, I want them. And boom, we just hit it. Now, I don't know if it's going to go further down. It could go down to now. Since I think the front month can go down another 20 cents, that means these guys can go down to $2.75-ish. So I'm being careful. I have a couple of 299. If they go down to 280, or probably if they go down to 290, I'll certainly buy 2 more. And then I'll have 4 at 295. And if they go down, if they go down 10 more cents below that to 285, I'll buy 4 more probably, and I'll have 8 long at 285. And I think I'll probably be happy with that. And of course, if it goes back up, to 285, I'll cut back, and then we'll see what happens. But I would like to have ideally 4 contracts at about this price in this range. And I had 4 contracts yesterday. I just happened to break even, so I cut my basis. So I started 305. I bought when it hit 295 yesterday. I bought more. It went to 3, and I cut back. So now my basis is 3. And if I do that trick again, my basis will be 295. And if I do that trick again, then my basis will be 290. That's how you cut back your basis, by going in and out. But there's no reason to be long on oil. We were talking about that earlier. There's no reason to be long on gas. There's no reason to be long on gasoline. There's no demand. There's not even a holiday or anything coming around. Got Easter. I don't know when Easter is this year, but it's sometime in March or April. But that's not a real big driving holiday. So you don't really have any good excuses for a gasoline sort of burst until Memorial Day in May, right? Whichever one it is. Anyway, so until the May holiday, that's when you get the pressure begins. So sometime in late April, probably when the April contract rolls over, we're going to want to be starting to get really bullish on oil and gas. At the moment, though, no, all I'm caring about is the long game right now. ESRX at Teva, we sold some puts. Yeah, in the LTT we sold some ESRX puts. Teva we have a whole position on. And what about Teva after the pullback? Is that the question? The ESRX has been good since we got it. Let's see, ESRX is just here. See these? That's just like last week, right? When was the 17th? What's today? Yeah, last week. So we sold, it's not a big thing. We sold 65 puts for $750. So our net entry is $57.50, which is quite a bit below where we are now. And it was a good premium. We're still at the same place, basically. I like the sale. And what's the net of it, though? The gist is we pocket $37.50. And again, whenever the long-term portfolio, is losing money, or not the long-term portfolio, sorry, whenever the short-term portfolio, the hedges are losing money, I like to offset that in the long-term portfolio by doing something that puts the money in the long-term portfolio. Effectively, what we're doing is transferring money from the short-term portfolio to the long-term portfolio, right? So I'm going to take a hit in the short-term portfolio by taking a loss on some hedges, but in the long-term portfolio, I say, well, in that case, if I'm going to lose a few $1,000 on this hedge, why don't I sell something for a few $1,000 here to offset it? And obviously, if I take something that essentially moves with the market, I try to find obviously good stuff, but if I take something that's generally going to move with the market, if I'm losing money in the short-term portfolio, I must be making money here. So, it's only been a week, or not even a week, but we're up $188 on that, so that's okay. We did Berkshire, was another one we just picked up, right? And that's up a little bit also. And who was the other one? I forget. Qualcomm. Oh, yeah, Qualcomm. We talked about Qualcomm at the last webinar, right? So here's Qualcomm. And what is today? 22nd. Well, at some point we talked about Qualcomm. And those are great. We sold a $55 puts for $10.50. I mean, it's crazy. It's 20%. Why would we not? No wonder I was so excited about those when we did it. It's like, why would you not do that? You're getting 20% off a great company. It's like, why would you not take that deal? They're still $9. It's still a good deal. But we dropped $5,000 into our pockets for promising to buy Qualcomm for net 45, not even 45, 44.50. Why did you not do that? All I'm doing in an appropriately sized portfolio, all I'm doing is promising to buy a stock I really like anyway. It's a no-brainer. And you don't do them all the time. That's the only problem. If you don't overcommit, every month we try to find a couple of stocks, one stock, two stocks, that we're willing to promise to buy. And we're doing that, though, also in the context of knowing that most of these positions, all but 2 out of 27, so 25 out of 27 of these positions are paying off and are in incredibly good shape. I mean, they're 50, 45, 100. No, there's something wrong. It's a $13 put. Something got to be wrong with that. Okay. Let's ignore that one. It's probably just a bad reading. 38%, 47, 80, 70, 80 and 75, we can close those. There's almost no point in leaving them at this point, right? So they're so high. 80, and that's the thing. If we shut these down, then we free up the margin. Okay, like in Canada, we want to wait a year to get 35 more cents. If we're tying up, we're not tying up much, but we're tying up $21,000. Obviously not margin, but we're tying up $21,000 of a commitment to say we're willing to buy $21,000 worth of Encana in exchange for $1,000. It's not a good return. We're getting $1,000 off of $21,000. We could do better. So probably time to retire that one. That's what you got to look at them. So every once in a while we do a little purge and we cut them back. And I like to have around 24. I like to have one a month for 2 years as a roll. And then it comes close to the time they expire. And so I'm always trying to sell the longest out one I can. So that means naturally, when we hit like July, I'll start selling 2020. So we have some leftover 2018s in here. Well, let's see how many. Hang on. Control F, 2018. Okay, so that makes it easy to see. 1, 2, 3, 4, 5, 6, 7, 8, and there's a 2017, 9. So 9 of these 27, 1/3, that's very good. So 9 of the 27 are going to expire by the end of this year. How many months are in a year? 12. So we're exactly on schedule. 9 of our 27 calls, 9 of these contracts will expire this year. So by the end of the year, if I do nothing, I'm going to have 9 open spaces to sell more 20s. Then I'll be selling 2020s. And then obviously I'll be at this position a year from now, and I'll be saying the same thing. I'll be like, look, this many of these 2019s are going to expire by the end of the year, and then we're going to start selling 2021s. And that's it. And we just keep rolling and rolling, and we just keep doing that. And, you're selling again, you add this up. What did we sell here? Just, bear with me on this. I'm going to call it out exactly. Let's say 7.5, 13, 20, 17, 18, 22, 32, 40, 45, 50, 50, 60, call that, 70, 80, 90, 100, 110, 120, 130, so $130-something thousand of short puts that we sold. That if we do nothing else in this entire portfolio, if we don't do a single thing, and these guys all stay where they're supposed to be and expire worthless, we will be, that's $130,000 off a $150,000 portfolio. That's 30% in 2 years. That's doing nothing. That's just the freaking short puts that we promise in the portfolio. It's a wonderful passive strategy, and all we're ever doing is promising to buy something if it's cheap. And look at the losers. Our losers are costing us $1,500 here and $400 there. That's not damaging. And they're both in the money. Like Best Buy is at 41, and we promised to buy it for 40. We're good there. And the other one is RH, and RH is at 26, and we promised to buy it for 25. So they're both on track. Yeah, whoever I told that about being on track. I don't care that it's in the red. It's not my fault that they want to consider this down $1,500. I sold the $25 puts for $6. That means I have to buy Restoration Hardware for $19. Restoration Hardware is now $26. I'm not going to give you $1,500. It only cost me $1,500 if I close it out and give it to you. I'm not going to give it to you because I'm fully confident in the position. And when we get to January 2019 and RH is above 25, it expires worthless. And in fact, this entire negative 7,000, which is more than we started with, right now it's negative against my portfolio. But that's going to reverse and turn to a zero. The money is already there. The money is already sitting where it says cash. Look, don't do that. Yeah, there's the money. Already in the portfolio, sitting around. Waiting for me to do something interesting with it. All right, TIBA. Oh, did we ever look at TIBA? All right, enough of that. TIBA, there's nothing to it. I mean, we've got the 20. In fact, we're on track, except we had a very aggressive put sale. But we sold the 25-35 bull call spread. It's at 36, so we're on track. Same thing. Don't care. Don't care what these numbers say. This one, too. I do care a little bit because we sold the $45 puts. We were very aggressive with our put sale because our target is much higher than it is now. Where is TIBA? But it's not off track. Do I think TIBA can get back to 40 in a year? Yeah. And if it doesn't, we're just going to roll them. But meanwhile, we sold these for $4. So our net on here is 41. So that's what we need. If it gets back to 41, we're even, and this negative 6,400 goes away. And we collect and we collect the money here. We'll collect our $10,000 here, and we'll be done. If it doesn't, we'll have to roll it. Then you look at TIBA and you say, okay, January 45. So the 45s are 1050-ish. And then if I want to roll to 2019, what would I do? No, see, that's why we haven't rolled them, because maybe I could roll to the 4250s. I wouldn't do that, though. That's a waste of time. I'd probably be more likely to want to double down and roll to the 35s, and then we'd be in the money. But a bigger commitment. But on the other hand, it's a bigger commitment, but it's possibly worth it. But still, I haven't given up on 45 yet. And so I'd rather give it 6 months and see where we are. I mean, 6 months, if we're at 41, then I'm going to be completely not worried. So I don't want to do anything rash. I don't want to jump into a move or do anything I don't have to do. I'm just going to ride it out and see what happens. You mentioned last week that you were going to look at the UNG position, may change to LNG. Any thoughts? My thoughts are waiting. Yeah, I'm waiting to see what happens because UNG just had a huge pullback. Not a good time to take a loss. We want to see if it turns back around. I'm happy that LNG is getting cheaper, hopefully, but I don't think it's really come down enough to make it exciting. Obviously, the natural gas prices go down. LNG is affected. See, they come down a little bit. I would love them to crash like that. So here's the thing. If natural gas crashes and UNG goes in the tank, then these guys are probably going to get affected. Right now, they're barely being affected because their story is very powerful. I would love to catch them, not here. I'm a little greedy. I'd like to catch them on the 200-day moving average. Then I would make a gung-ho position. Even if we still have our UNGs, I'll be very happy to pick up a nice position on this one. And we'll ultimately, then when natural gas comes back up, we'll dump the UNGs and stick with these guys. That's the plan. But again, patience. So yes, that is what I want to do. But am I doing it now because I said it last week? No. Okay, we just have to wait until there's a good timing on both. Are you still very confident with it being made the trade of the year? Oh, yeah, sure, of course, SLW. Yeah, no, it's a commodity. Commodities go up and they go down. You can't go by any couple of months or a couple of weeks. It'll go up and down all over the place. Trump changing environmental regulations on coal. That is one of the stupidest things that anybody's ever done in the history of doing things. First of all, there are now 2 times more people working in renewable energy in the United States than there are people working in the coal or oil industry. There are more people in solar than coal and oil combined. Okay, that's a lot. So what he's doing is killing, to every job he creates, he's killing 2 jobs in coal. So every Yahoo person in West Virginia he makes happy, he's killing 2 perfectly good solar jobs in other places. And those coal jobs suck. It's all people know. It's like in England. I know in England has mining towns. And people are coal miners, and they've been coal miners their whole lives, and their family, their father was a coal miner, and their grandfather was a coal miner, and their great-grandfather was a coal miner, and that's what they do. They're coal miners, okay? And we're not that different off in West Virginia and places like that. These people are coal miners. Their job is to work in a coal mine. If they don't work in a coal mine, they have no frickin' idea what to do with themselves. So they freak out if somebody tells them they're going to close the coal mine. That doesn't make it right. Okay, we should be looking forward and leading the world in solar energy and clean energy and wind energy and stuff like that. This is bullshit. This is backwards-looking idiocy. Oh, is it 2 o'clock? Oh, wow, I totally missed that. Okay. All right, good warning. Unfortunately, the way the system works, I saw it. So what happened? Nothing much. Damn it, I knew I wanted to short staff. Oh, well. So a little bit of a dip, but nothing exciting. I'm going to buy one more oil, one more gas. I'll be pissed off if $2.95 gets away from me. All right. So that's good. Nothing exciting. We got a bit of a dip, and we'll see what they said, but I'm sure they said generally what I thought they said, which is they want to be a little bit tighter. Let's take a look. Oh, Fed. Ha! That was easy. Fed minutes suggest leaning towards the March rate. Like many believe Fed fund rate should be boosted fairly soon, according to, should incoming labor and inflation data be stronger than current expectations, according to the minutes. So that's January 31st, so there hasn't been much data coming in since then, but we did have a strong jobs report, and we also had strong PMI inflation reports, CPI and PPI. Holding back from wanting to hike is the uncertainty over the path of policy. You don't know what the hell Trump is doing. And so many believe the funds should be soon, and a sizable minority, so of the many, there's a bunch in the many that believe that rate hikes have to move more quickly than that. So that's what they're telling you. They're telling you that the majority vote is to hike in March. Unless something changes the mind of the voters, they will hike in March. I don't know how much more clear they can be, but apparently the Fed really, it's like, they can't just tell you what they're going to do. Otherwise, they lose a lot of their ability to finesse the market. I've never seen a statement more clear from the Fed. They're telling you that many is more than one. Okay, there's 12 governors. There's, I don't know, like 9 voters or something like that. So there's 9 voters, and they say many. Many is not 5 out of 9. Many is 6 out of 9. Many is maybe 7 out of 9. Okay? And a sizable minority, that's not 1 and it's not 2. It's 3 or 4 believe that rates have to rise more quickly. You are not going to go from that to no hike. And the market is seriously not pricing this in. I mean, they refuse to believe it. And of course they refuse to believe it because the Fed constantly says they're going to raise rates and they don't. So yeah, I can understand not believing it, but this is getting a bit silly. It's bouncing right back up. I love it. And the market goes up again. But anyway, so there's nothing there that surprises me. And apparently it's not bothering the markets after the initial shock of seeing a March hike. So we'll see what the actual net reaction is. All right, thanks for reminding me of that. October contract it is. We'll need to work out from in. Yeah, just look. I always, the way I do it, when it goes down on me, I add the longer months, and then when it starts coming back, I get rid of the short month. That's all. Now, how do you see that being dovish? That was not dovish. Tepper went big on pharma. The fund took in new positions. Teva, well, I agree with him there. Pfizer, Pfizer, it's true. I haven't looked at Pfizer in ages. I like Pfizer. Are they cheap? Yeah, they got kind of cheap. Yeah, 30 is my buy price for Pfizer. So yeah, I missed it. I do like Pfizer at 30. In fact, in one of our videos, Pfizer is the example of the stock we like to buy at $30. I forget which one, but one of our how to make money in the market videos, Pfizer is the example stock. So yeah, I like Pfizer. That's a shame. And I won't chase it. It was 10% higher than I wanted. I don't want it. I'm not going to. Not important enough for me to run after it. Futures are getting sold off only for 10 seconds. Are you looking to create a new SCO trade? If so, what is your... No, because that's it. It's over. We're getting into the summer now. Look, oil. Energy, yes, energy, oil, weekly. Okay, here you go. Okay. 2015, summertime. 2016, summertime. Well, sometimes over there. All right, so, well, okay, actually, to tell you the truth here, 2015 summer was a disaster. This is June. So this is July 1st, the middle, right? So here's June. This is what I care about, though. We're out, we're playing for this. We're playing for this May move. So you get the May move here. You see the May move here. 2014, here's the move into May. 2013, took a little longer than you thought, but it still moved, right? 2012, there's your move. Not 2012, sorry. I got to go further back now. Now do the monthly, see if we can do that. Hard to read. Okay. Still, okay, we had a huge drop, whatever, but then it recovers into the summer. 2011, you started off crazy. Well, 140 is crazy, so we won't pay attention to that. What is this? How could this be? Oh, it's probably this contract. That's why. It's probably this contract in 2007. Can you believe it? Yeah, so the 2000, that makes sense. The 2017 contract, the front month, that's what this is reading. So the April 2017 contract in 2008 went up over $200. So when oil was $140, people were thinking it's going to keep going to $200 a barrel. Boy, one of the Arabs are pissed off, huh? unless they sold to a bunch of suckers over here. I would have sold everything I had for $200 a barrel. I would have sold you 20 years worth of oil. Wow, that's crazy. Anyway, where were we? Oh, yeah. So 2011 was a crazy year. Can't count that. This year you had a big drop, then it picks up. You can count on this almost all the time. You can count on a run up after any, into May at least. So I'm not fighting the tide. I'm not betting short. So no. So there won't be any SCO. Oh, wait, is SCO the long one or the short one? The short one, right? I'm sure I got my premise right. SCO is short, right? No, not SCO. UCO, if we get a nice dip, I might go UCO. That's the ultra long. But as it stands now, I'm not really interested at all. I mean, it's we have something long in oil. What portfolio is that? We do have a July long in oil. Must be, is it the OOP? Ah! 166.6. Oh, we're doomed. There it is, guys. That's the sign. All right, so let's see. Don't we have oh, here you go. See, we have the USO bull call spread for July. So we're long on oil in July. We paid $1.30 for this contract, and it's a $3 contract. It's a $3 spread. So it's a modest little thing, and we're already up $1,200. So happy. That's what our position is in oil at the moment. We have no shorts. We are long. Not very long, because it's already at 11.36, and we say it's going to get to 12. But so that's our goal. You know, the SCO, we had the SCO, but that expired, and we're done with it. We're done being short on oil officially. And, you know, intraday, short-term, things like that, we'll do whatever. But this is a very iffy time, and it won't be an exciting time. I won't be definitive about going long until we get to April. But if oil for some reason crashes down to 50 or 45, I will then want to pick up some long. I want to get a little more aggressive on the long side. But at 55 or 53, it's not exciting as a long right now. I don't think we're going to get much past 60 all year. So basically I have no interest in playing it either way right now. I don't see any particular reason it'll go down. I don't see any particular reason it'll go up right now. It's going to drift along. But I do see that in July, I'll tell you, it'll damn sure be over 55. So that's what I bet. So what's your target price on the CL? No, see, we're not. The only reason I would get short on oil, and it would be very short term, and I'd be disinclined to play SCO. But if oil pops again, and here we are failing 53.50, if oil pops again up to 55, I'll play it short. At 54.50, I'll play it short. But I have no reason to play it long here. In fact, I said today, below this line, we're probably going to leg down. You know, we talked about this today. Let's take a look at how we're holding up. A good 5% rule lesson here. Oh no, it's gasoline. Damn it. So is oil. Let's see. I said here, you got the drop in gasoline from $1.60 to 148.5. That's 11.5 cents. So 20% of that drop is a 0.25 ounce. Not really 0.23, but you know, you get the idea. So we'll call it 0.25 to be even. And that means that you're looking for $1.51. It's a little small, this thing. I guess we can control plus. Is that it? Yes. Oh, too big. With my finger. There we go. All right. So there's your base. And then you're looking for 151 is a weak bounce. 153.5 is a strong bounce. So here's your weak bounce, 151 in this middle range here. And here is 153, and that one basically touched 153.5, which is a strong bounce. So strong bounce, rejected. Strong bounce, rejected. Weak bounce, rejected. And what I said, if 151 fails on this run, so here, back to 151, and if 151 is rejected, this is gasoline, not oil. 151 is rejected, then probably we're going to fall through 150 and retest 148.5 and probably go lower. Okay, so technically, according to the 5% rule, that's where we are there. Now, let's apply that logic to oil. It's the same thing. Oh, that's weird. If you blow up one page, it doesn't blow them all up. Okay, let me put this one back the way it belongs. Okay. That's very weird. Okay, here's oil. Look at the dailies first. Not too much. Okay, look at the hourlies. All right, here we go. So this is a little tricky because, I mean, I barely count 55, but let's say it was trying at 55. No, you know what? I'm going to reject that notion. Let's say 55 made no sense. This was the end of the contract, and it was really stupid. So Let's say 54.50 because we've had that line a few times. So let's say 54.50 is where we fell from. And we did literally from here, but let's ignore this. So 54.50 to 53.50 is a buck, obviously, and that means we're going to be looking for a 20-cent weak bounce and a 40-cent strong bounce. Now we get to the 5-minute chart. And from 54.50 to 55, that means we're going to be looking for 53.50. We're going to be looking for 53.70, which is right about here. See that? And there's your weak bounce. So we're not even making a weak bounce in oil. All right, so most likely oil is going to break down further from here. So if you must trade, if it bothers you not to trade oil, then technically we're probably looking pretty weak. All right, but there's no particular reason to play it that way. That's the thing. And personally, I don't like to play it. I don't have an actual a news reason to do it. If there's nothing happening that makes me want to play it, or at least if there's an inventory report I'm anticipating or something, I don't want to just play it just because it's there. You know, I like to play when I'm sure. I like to play when we have an advantage. So Pfizer, yes, you can. Yeah, of course you can do that. I would be more aggressive. I'd sell the 32 puts and make more money. But whatever. I mean, there's nothing wrong with Pfizer. I'm just saying I'm not going to chase it because I could have gotten 10% lower. So I don't have any particular reason that I need to own it. It's a nice stock. They pay a nice dividend, like 6%. You can sell the 32 puts for $3. That puts you in net 29. You could sell the 35 puts for $4.75, and that puts you in the 29 at 30. That gives you upside, right? So it's at 33, which it's at now, 33.50. You would pay back $1.50 on these puts. So that means you would make $2.25. Okay, now to me, I'd rather have that's the thing. If it's flat, you make $2.25. If it's flat on these, you make $3.20. I'd rather make $3.20 than $2.25. Even though you're capped at $3.20, I got a better. I'm already well in the money. I have a 5% cushion, so I would probably select the 32s and sell them for $3.20. Then I'm all the way down to 29 net, or 28.80, whatever. All right. So how these things again? Very indecisive. Very, very indecisive market. The gasoline is popping up. Here we are at 151.30. And oil, not looking good, but it's gas. Now, see, here's the thing. If I'm thinking of shorting oil, first of all, the dollar's getting weaker. Don't want to short oil. Gasoline is looking strong. Don't want to short oil. Natural gas picking up a little bit. Don't want to short oil. I have to have confirmation, and the indexes are strong. So for what reason would I short oil right now? I have no reason. It has to be, even if I have a technical reason to short oil, I still want a confirmation from other things that there's going to be a tanking here. Just not seeing it anywhere. Coffee. Oh, wow. Coffee pulled back nicely. Nice. Okay. See, I want to get back in my coffees too. KC. What coffees did I have? Wasn't V, was it? KCV. I don't have any more. That's the problem. KCV7. There's no. I don't know. Whatever copies I had. / KC. I got out of 155. July. Oh, I see. They skipped. KCU. KCN. That's what I have as the ends. Okay. KCN7. I'm seeing where they added that natural gas. Look what's happening. KCN7. Oh, yeah, see? I got out of the 155. All right, so I got out of here. I mean, 152.50 is a nice pullback, and I don't mind reinitiating here. They stopped trading though for the day, so that changing my mind. I'm not going to re-get in because they're not trading. So obviously I'm not going to do anything. See, there's nothing. There's no activity because they stopped trading about 1 o'clock or so. So who knows what this is? Maybe it'll continue down. Maybe it'll pop back up. But I'm out for now. Even if I get back in, if they break back up 155, I'm just back on my train. We started at 150, and we hit 155. It got rejected at 155, so of course we stop out and take a nickel profit. You know, profit's a lot of money. It's 185 per penny, so 5, 9, like $1,000. So I had a few contracts long, and I took the money and got out, and now we're just going to wait and see what happens. You know, again, with futures, it's like just take the money, take the money, take the money. When you make a nice profit, take it. If it gets away from you, so what? You go find something else to trade. There's always something else to trade. Like, look at these guys, right? I wouldn't chase them up. I'm not going to chase them down. They're doing what they're doing. You know, same thing for oil. If there's no good reason, a great reason to get into a trade, don't get into the trade. Save yourself a lot of headache and don't participate in every single thing that goes by. Wait until you think you see something that makes sense, that gives you a good reason. Here, look at silver popping back up real fast. You know, these are commodities. They're silly. They go up, they go down. So when you make money, take it off the table. When it goes, then wait for it to come back down. If it doesn't come down, find something else you like and trade that. Don't chase. Don't overpay. You pretty much can't name a commodity that hasn't gone both ways in the last couple of years. Like, here, where's that thing? All right, here's oil. Check this out. Oil monthly. You know, indexes, yes. Up and up and up, right? This is back to 2012. But oil, down. Rent down, gasoline down, heating oil down, natural gas up, down, ethanol up. Ethanol, that's interesting. I didn't know ethanol was so strong. Gold down, silver down, platinum down, every item down, palladium up and down, cattle up and down. You know, every commodity is like that. Look, cocoa, complete round trip. Probably getting to be a buy here, but who knows? We got to find out why. Is coffee down, up, down, and so we're buying it now. That's why I like coffee. It's down. It's a crop. There are more people and not necessarily more crops. So you look for things like that. Lumber we played recently, right? We just had a huge spike in lumber, right? It hit this 300 line, not this contract, but when lumber hit 300, I was like, oh, that's really good. Let's do that. Sometimes we play sugar. Sometimes we play copper. We played when it was down. When copper was down here, I liked it. Now I don't like it. I'm not interested. I'm not chasing it up. I'll wait till it comes down again. And if it's not copper, somebody else will fall apart. Soybeans. What did we just read about soybeans? Oh, right. Because wheat, where's wheat? Wheat. Because wheat is getting crappy prices, farmers are switching to soybeans. I had a chart today. Okay, trust me, I'm not going to look for it. So, what time is it? All right. So, because the difference between this isn't really the determination. So the farmers, how much money do you get for an acre of soybeans compared to an acre of wheat? Therefore, which one do you plant? That's all they care about. Where do I make more money? Now, there's certain factors. You can't plant the same thing all the time when you're in the soil, so on and so forth. But the gist of it is there's a huge amount of more farmers planting soybeans now because soybeans have held their price well while wheat has collapsed. So probably it's a good time to look at wheat. Wheat is at, take a very close look, Wheat is at just off 400. It's now at 450 again. But if the farmers aren't growing wheat, then wheat will eventually get short. Now, brain surgery, I read that article today. It's an actionable item today. You can buy wheat at 450. All right, I look at the building trends to look at copper. And by the way, one building trend I didn't like, which I don't like for copper, is although housing activity is picking up, not new homes so much, and also architectural. There's something about like there's an index of architectural plans. So in other words, how many architects are engaged in plans for buildings? That list is way down. So that means that there's less commercial properties in the planning stages than usual. And that's bad for copper. Because that's where a lot of it goes on that kind of stuff on buildings. You know, construction is a big part of copper usage. And China has a weird, scary stockpiles of things like copper. You've got to be very careful playing that one because it can get knocked around the world market at will. All right, but we're living in this golden age right now where energy prices are cheap. Oil again, gasoline, heating oil, natural gas, ethanol is stupid because it's fake. It's like you don't need it, especially when oil is cheap. But ethanol is like way up there. This is when the mandate came in. That's why they have the mandate for ethanol, and so you're forcing that mandate. How does that affect corn? Now, see, how does it help corn? Still have way too much corn in this country. We ship out so much corn, and we produce so much more corn than we need. You know, they try to stuff us with it, but can't get enough down our throats to keep it going. So we have this really cheap energy. Materials are pretty cheap right now. It's all big positives for the industrials. This is, you know, good for the Dow. But when these things start getting more expensive, when these prices start rising, then the input cost for the industrials is going to go up, and you're going to get some massive, massive inflation. And nobody's playing that. This is our trade of the year, silver. You know, we're using silver wheat as a proxy. But silver is I think, certainly going to go over 20. It's 18, whatever. It's 18 now. Gold is, now, silver's over 20. That means gold's going to be back around 1,400. 1,350 at least, I'd say gold will be. So gold's another one that can be played long. But these are scary, volatile things that go up and down violently. This is a nice, smoothed out monthly chart. You know, you look at the daily chart, and these things are really all over the place. This way it's going down here and up here and down here and up here. Silver, too, all over the place. Copper, like that, all over the place. Natural gas, big round trip from $4. Look at this. Down here, up to $4, all the way back down here. So, you know, you can extrapolate that natural gas will go to zero, or you can say, well, you know what, it costs money to get it out of the ground, and it costs money to transport it, it costs money to put it in the pipes. There's a limit to how low it's going to go. And if you don't have the balls to buy when something is low, when are you going to buy? Are you only going to buy things that are trending up, that are getting away from you? Like you see these charts? Like, you know, you see gold go to 1140, and you say, oh, no, it's going to go to, now I think it's going to go to 1050. You can't do that. You have to have a value in your head that you think is the right price. And when it goes below that price, you say, oh, it's cheap, I'm going to buy it. You can't trade just based on which way the chart looks like it's going. That's not a premise. And there's no predictability to these things. There really isn't. They look down, 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 and all of a sudden up. Copper too, down, down, down. 250 was my buy line for copper. That's when we were buying. Now it's at 275. You can't. It goes to 250. You don't know when it's going to go up. But you have to say, I think 250 is a very fair price. That's all. And it's the same thing when it was the same thing when wheat got down to like 400. I said the same thing. When wheat was 400 last year, I'm like, that's a really good price for wheat. I don't play wheat very often, but I saw 400. I'm like, hey, you know what? 400 is good. Let's do that. You know, and corn at 300 too. Corn was 300 last year. Now it's like 380. I mean, it was obvious that was a good price, but it's not obvious on the chart when the chart looks like hell. And I do the same thing with stocks, and everybody, all the technical guys freak out. They're like, oh, no, that's such an ugly chart. I'm like, I don't care what the chart says. Like, who was the guy we were talking about today who had a PE of 10? Let me pick a new trade on that today. You talk about so many different things in chat. It's amazing. It's gasoline. That's Lumber Liquidators. That's not the one we were talking about. Is it Hain? No, it wasn't Hain. It wasn't Tesla. Oh, CSIQ's hanging on. That's good. Oh, come on. When we're talking about somebody with PE of 10, when we're talking about a fair price. Oh, well. Hang on. Control F. It's only one day. 10. 32 times I said 10. Well, that's because we got a guy named 1020. Oh, and time 10 o'clock. Okay. See why this is a problem. 10X. There you go. LL. Oh, it was LL. All right. So, with Lumber Liquidators, we were trying to figure out what's a fair price for them, and I said that I believe that their legal issues are behind them. Their earnings are such that they've in years where they have earned $1 billion, where they've had $1 billion in sales, they've dropped $65 billion to the bottom line, and so that's cheap when they have a $500 million current valuation at 18. So I think 650, 10 times earnings is fair, and that means the price should be $23.40. Okay? So in other words, if it's $500 million now at 18, and I think 650 is a fair price for the company, that's 30% higher than 500 million. Therefore, I take 30% and apply it to 18, and I come up with a target price of $23.40. So that's what I think Lumber Liquidators should be. So this is what I do. That in a nutshell is what I do when I'm valuing companies. I look at them and I figure out how much is this company or commodity or whatever worth. And from that, I say, okay, now I know what my target is. So because of that, I said, okay, well then the 15-22 spread makes sense because our target is 23. So 15, I got no problem with, and there's almost no way I see it being less. So if I have the 15-22 spread at 330, that means my break even is 1830, right where we are now. So I'm thinking that's a very fair price. I don't think we're going to go lower than this. So forget the fact that we're also selling some puts to offset it. But I'm saying the point being that I take a thing that's a nice fair price, and I take a bottom I'm willing to live with. So that's why we're selling 17 puts. For the same thing. I think it's safe to sell the 17 puts. It doesn't give us a lot of cushion, but I want the money for the 17 puts. So I said I'd rather sell 5 17 puts and see what happens. Okay, so even if it goes down lower, it's easy to roll and double down to like the 12 puts or whatever and get it that way. But the point is, and then a month from now, everybody's going to forget this except for me, and Lumber Liquidators will crash and go down to 13 because of some bad news or something, and I'll look at it and say, well, no, I still see this and I still see that, and that means I still think they're worth $23, and therefore I'm not going to panic just because the chart says no, and we're going to get in. And I mean, talk about a bad chart. Holy crap. I mean, we held these guys. We had a big position. We're out of most of it now. We still have some. This is when we were buying Lumber Liquidators. We were buying it down here. We bought it. In fact, we bought it here, at 20, and we bought much more when it went down to 12. And when it went to 10, we didn't change our mind. And it took a long freaking time for this thing to get back on its feet. But remember, they were under attack because of, like, giving people cancer with their floorboards or whatever crap they were being accused of. Formaldehyde poisoning, something like that. But it's just, it all blows over time. But if you're not willing to buy here, and if you're not willing to have the conviction to buy more when it goes down and not stop yourself out, because of what you were ever doing was going by some chart, you're going to have a lot of trouble trading and making money. Learning how to evaluate something and sticking with a trade and putting your flag down and saying, this is my trade, that's how all the big boys make money. That's how the fun guys make money. There are not very many day trading funds. Most funds, they pick positions for the long term that they get into, and they accumulate when they're low, and they dollar cost average into them. That's what most funds do. They don't get in and out of stuff constantly. They don't panic out of positions. If they like a company, they like a company. They research. And if the research says this is a good company, they buy it and they stick with it. And that's why they all have price targets. That's why every time you see them on Bloomberg or CNBC, they go, what's your price target on this stuff? They all have price targets because they all say, this is where I think it's going to be. That's the whole premise of their trades. How much is it worth? But boy, this lunatic for Tesla today, he was like talking about it being worth 30 times more than it is now. That guy's completely out of line. We'll see, though, because I made a big deal in this morning's article about shorting Tesla. So we will see what happens. I think they're going to announce after the close. Yeah, that's a good girlfriend, actually. Sometimes. Did we start any new futures positions in the webinar? Officially? Didn't I click something? I don't even remember. Open on this thing. It's on my usual account. It's my special webinar account. NG. Oh, yeah, I bought one NG. That's all. So, chart. So, no, all I did was add that NG long, which is working already. So told you so. But see, it's the same thing. All right, well, that's a good example. NG, the long one, right? NG E7? Yes, okay. So we hit 295. It was looking ugly. I even said I think it can go down to 285, but that didn't stop me because I said, I'll be mad if 295 gets away from me. So I bought another contract at 295. Now it's up to 297. So that contract made a couple $100. Didn't save me yet. I'm still down on the net of the trade. But now I've lowered my cost basis by a penny on all three the three contracts. So if I take off, if it hits 297, sorry, if it hits 298, and I get out here, I've dropped my entire basis to 298. I've dropped 2 cents off my whole basis on my contracts. And that's what I do all the time. I go in, I go out. I go in, I go out, and I keep lowering my basis. Because that's all I care about. If I can drop my basis a penny, I'm thrilled. Because if you drop your penny 20 times, you've knocked 20 cents off your basis. So you should be really happy with a penny if you're going to be in something for a long time. Every penny counts a lot. But right now I got these 3 longs. As I said, I wanted 4 longs, but I want 4 longs at a lower price. So I still actually hope NG goes down quite a bit lower. But discipline-wise, I have to sell when it goes up here. Watch this. I hit a sell. I have to sell one there. Because then I'm back to 2 contracts, and then if it dumps down, I'm happy. Now, if it never dumps down, well, I'm still kind of happy because I got 2 contracts and it's going to go flying, and I've got them until October. So that's that position. I don't really have any others I particularly like. Well, like I said, I like wheat because the lack of planting. I don't even know what the symbol for wheat is, frankly. And like I said, this is just a webinar. I set up a special thing just to do webinars with, so it's not like I really want a whole bunch of long positions in here. Wheat. Not silver wheat. Not, oh, there's a wheat fund. You know how bad funds are, though. No, Thinkorswim doesn't have wheat futures. You have to, up here. NQ Wicker. No. So, not something really you can trade here. But if you're into that kind of stuff, yeah, I like wheat. We like wheat and silver wheat. How's that for a pair? All right, let's wrap it up. I'm getting punchy. So the indexes are pulling back because people are starting to have meetings and saying, oh, well, the Fed's kind of serious about the March thing, and we'll see what happens. We'll see if there's a change in sentiment from all this stuff. So I have the 3, and if it goes up, I'll go back to 2, and then we'll see what happens, basically. But on the whole, my goal is hopefully to have 4 of them at a good price. But I have 2 at a good price already, so we'll see what happens. All right? All right, thanks a lot, guys, and we will pick it up again next week. Oh, I'll be in, where am I going to be? I'll be at the New York Traders Expo at the Marriott Marquis on Monday. I don't know what time my things are. I know they have me doing 2 seminars, and we also are going to have some kind of booth, so you can stop by and talk to me there, too. So if anybody's around New York, come over to the Traders Expo and say hi. All right, take care, guys. Oh, ZW is weak. Wait. Important last-minute information. How come I didn't come up on the list then? ZW. Oh, wheat futures. Ah, look, see, popped up already. So let's see, ZW V7. No October for wheat. ZW U. There you go. All right, so you can do September wheat contracts. So here's 480 line seems to be holding, and we're at 484, and it's not trading right now. Either it's not trading or it's got incredibly ridiculously wide bands, so I'd say basically it's not trading. Anyway, so wheat. I like wheat at 484.5, so that officially is one that I do like for a contract. But I won't trade it myself because I don't feel like sitting there and watching wheat. It's not that exciting to me. But I do think that based on the fact that soybeans are being planted in lieu of wheat, therefore wheat theoretically should have a bit of a shortage towards the end of the year. And that's it. That's investing. That's just come up with a premise, have some logic, and then see if your premise holds up. All right? Thanks a lot, guys. Take care.